Welcome to Real Estate Talk, part of the Realty Media Group. We also produce The Property Show, Real Estate Uncut and CoreLogic's auction updates. All available for catch-up anytime at realty.com.au. Before we get underway, thanks to BMT Tax Depreciation, Printforce and Propertyology for their support. Good morning and welcome to the show. Well, nationally, the portion of profit-making sales in the March quarter fell to 87.7%. from 88.7% in the December quarter. Losses totaled $908.6 million in that quarter. Eliza Owen helps us understand the findings from the latest CoreLogic Pain and Gain report. Also, the powerhouse markets of Melbourne and Sydney are showing signs of the impact of COVID. And now that Victoria is in close down, we can expect more angst. Josh Masters looks at all the markets around the country as we measure the overall impact city by city. What can you get for $700,000 if you're shopping for a property? Heron Todd White looked around the country, and just so we can prove it's possible to buy a property for that amount of money in all the states, I'm joined by Drew Hendry to take us through the possibilities. But first this week, technology and more recently artificial intelligence has enabled even the smallest real estate office and independent agency to compete with much larger businesses, but still be able to offer a more personalised service to tenants and property investors. This year, off the back of COVID-19, we've seen property managers rapidly adopt technology, allowing them to work remotely, carry out virtual inspections and book contactless appointments. It's also ramped up the opportunities offered by artificial intelligence like that created by Ben Burton from Rental Heroes. He's my guest. Ben, welcome to the show. I want to talk to you specifically about Rental Heroes in a moment. Before we do, I just wanted to focus on AI, artificial intelligence. It seems to me that it was very much, for the big boys somewhere in the future. But I tell you, that has really changed, hasn't it?
Yeah, look, absolutely, Kevin, and thank you very much for having me on your show. AI, believe it or not, so we're in the conversational AI game. There's many aspects of AI, but conversational AI actually started in 1966 by MIT over in the US. They built their first sort of simulated conversation, and it was a chatbot called Eliza. And sort of fast forward all of these years, we saw in 2010, sort of 2011, really the first commercialization of this conversational type AI, and that was typical for sort of big banks and telecommunication companies, insurance companies, and these guys obviously have big pockets and deep resources for technology. So really AI in a conversational way was the big boys. Consumers got used to interacting with what were rather ordinary chatbots back in the day for their banks and telcos, but they weren't really popping up in the small business space, and that was largely due to the large investment and bespoke development. And over the last few years, we've really seen AI reach consumers, so skipping from enterprise into consumers. And we see it almost every day now on our smartphones, where we are prompted with suggestions on how much time we should allow to get through traffic, calendar reminders, etc. But where we play and also where we see a big opportunity now is in the sort of small business space. So these are in the real estate space, franchisees that are owned by a group of owners. And this is where the opportunity for AI, we believe, is over the next couple of years.
We'll go deeper into Rental Heroes in a moment and a bit more about AI and its experiences. But before we do that, can I just get a bit of background from you? What led you to where you are now? What's your history?
Well, look, from a very young age, I always was in the backyard making contraptions and sort of inventions, as a lot of kids do. But I guess I always had that desire to make stuff. And more recently in my career, I spent the best part of a decade in the telecommunications industry, in the smartphone space, and so became very aware of how technology was moving and how users were adapting to that technology. My most recent job before I was a co-founder of Rental Heroes was working for a big health insurance company, and we were using artificial intelligence and digital channels to provide consumers with choice on how to access information when they need it and how they need it. And so I got exposed to a lot of the cutting edge applications of artificial intelligence. And it was largely that grounding in that enterprise space that inspired me to look at the property sector. And as a tenant and also as a landlord, actually, I saw an opportunity, along with my co-founder Dominic, to use this type of technology to try and make renting as an experience much better for tenants, but also much better for property managers and landlords. So I guess it was a combination of life's journeys and also where we are in terms of the evolution of AI technology globally that led to Rental Heroes.
Yeah, on the website, rentalheroes.com.au, there is a very good explainer video. Suggest you go and have a look at that. It tells you very much about how the system works. But just briefly about the website and the system, Ben, just walk me through how Rental Heroes works and why it is so different.
Yeah, sure. And thank you for the opportunity, Kevin. So look, Rental Heroes, we have a product and we call that product Alex. And Alex is a chatbot and he's powered by conversational artificial intelligence. But the way it works is Alex is like a personal assistant for every property manager. So if you're a property manager, you have access to Alex 24/7, and Alex actually communicates directly with your tenants. So in the first instance, tenants will access and talk to Alex, and Alex is going to try and, wherever possible, help solve a tenant question or issue himself through a self-service approach, and all of the back end is programmed with all those different options that respond to common tenant requests. And where not possible, Alex is going to simulate human behaviour and almost do what a property manager would do if they were talking to a tenant over the phone. So for example, if a tenant has a maintenance issue, which of course is one of the common use cases in property management, yep, Alex is going to go through a series of diagnostic questions to really try and understand right up front what that issue is, help the tenant with the common troubleshooting approaches for each type of issue. And if that's not possible, Alex is going to gather that information and put it seamlessly into the property manager's cloud-based CRM or trust accounting system or maintenance tracking system, so that they can go ahead and get on with getting that job done. So what Alex is doing here is he is removing the amount of emails and phone calls that go back and forth between property managers to understand and therefore action tenant requests.
Yeah, AI has come such a long way, hasn't it? I mean, when you're talking to Alex, it's like you're talking to a real person, and they react to what you say. And I guess just over time it learns, doesn't it? I mean, but they learn very quickly.
Absolutely, and it's all about the data. So companies like Rental Heroes, we're obviously very data hungry, and our success and the development of the product is only as good as the amount of data that we're consuming. So even today, we've been in the market for over 12 months now, but even today we occasionally see requests and questions come through that we just haven't seen before. And in that sort of case, Alex does learn, and we also update him so that the product keeps getting broader and deeper in its ability to intelligently respond to tenant human requests.
The beautiful part about it too, Ben, I guess, is the fact that you only have to teach Alex once. Once he learns, that's it. It's there forever.
That's true, and actually, in the artificial intelligence space, I mean, traditionally the sort of definition of artificial intelligence is to simulate machines are simulating human intelligence, but in some ways that's not true. Artificial intelligence, even today, has got to the point where it can surpass what a human can actually do. So there are literally hundreds of different permutations of types of conversation that Alex will engage in. And in some ways, it would take weeks to train a human being on how to get to that level of ability in terms of their ability to diagnose and respond to common tenant requests. So, yeah, artificial intelligence is getting seriously good. And in some ways, it is a better technology for some of these use cases than traditional human conversations.
Yeah, I want to take you, just before we finish, and we're getting very close, unfortunately, now to the end, because I really enjoy talking about this. I love technology, but I want you to take me into some of the areas that Alex is involved in to talk about the depth of his involvement in that rental process. But just before we do, I noticed a comment from you in one of your blog articles on your website where you talked about the adaptation or the adoption of AI and technology into a real estate office it needs for the user to be in the here and now. I think that was the term you used. Yeah, the here and now. Can you explain to me what you mean by that?
Yeah, sure. Look, there's a lot of hype, and that's natural, about artificial intelligence and where it's going and how it will shape our future world. And I think it's useful sometimes to sort of pare that back and look at, well right now, as a business owner of a real estate franchise, what can artificial intelligence do for me right now? And that will look very different, by the way, to what it can do for you in 1, 2, 5, 10 years' time. And so at Rental Heroes, we've built a product that slots straight into your existing systems and processes. So it is powered by this conversational AI, but it also links into your existing systems like Property Me or Property Tree or whatever system that you're using. And what that means is that we're not asking real estate branches to completely restructure the way they run their businesses. That may come in due course, but they can have a taste of the benefit of these technologies and the automation and the tenant experience that it drives, without having to fundamentally change the way their operating model works. And that's good in a couple of ways. So it gives you immediate benefit. So obviously we are helping property managers by removing phone calls and emails, and we're helping tenants by providing a 24/7 service that they've never had access to before. But what we're also doing is we're helping property management teams go on that artificial intelligence journey. So today, we are an AI chatbot and we do all of the things that I just spoke about. But in the future, like many AI tech companies, we will be so much more than that. Artificial intelligence lends itself to crunching big data in real time and presenting those findings back to their users. So we imagine a world where there's predictive maintenance, for example, where we're able to quite easily quantify the cost and the types of issues that might pop up before they even pop up.
Yeah, I think the predictive nature. Sorry to interrupt you. I think the predictive nature of what AI brings to the table is going to save a huge amount of time, frustration, and money for property owners as well. But we'll cover that maybe in another one of our talks. Can I just round this out, because I want to touch on just how deep Alex is already into a business and how much he can help tenants, because I think there's a figure, something almost like 80% of what Alex does in terms of urgent repairs are done out of hours. Is that right?
Yeah, that's right. So we're at 77% of requests that go through Alex are out of hours, and that just reflects the nature of people's lifestyles today. From a tenant perspective, it's super easy. So Alex does operate in Facebook Messenger at the moment, and we deliberately use that technology because that's a application that we find about 85% of tenants already have on their phones. So it removes barriers to entry in terms of logging into portals, downloading apps, etc. It's there in an application that you're already using every day. So that's one thing. That's what really drives that sort of tenant adoption. And what we are finding is, after working with new customers, after a few months, we're finding that 6 out of 10 requests are going through Alex and therefore benefiting from the automation and the superior technology that Alex is able to offer.
That's huge. That's massive, isn't it, when you think about it? 6 out of 10 are being handled by Alex.
Yeah, that's correct, and that's available today, and that's before we even think about all of the crazy stuff that you were mentioning earlier around where it's going in terms of the predictive aspects of artificial intelligence. So there's an immediate benefit. From a real estate agency's point of view, you can turn Alex on for as little as $99 per month, provide your tenants a superior experience and benefit from that automation at the back end. But more importantly, you're strategically getting into the artificial intelligence space so that you can grow with us. So as we deploy more features and Alex gets smarter and deeper, you're able to benefit from that as well. But today, Alex covers all sorts of things from maintenance, which is a big one. That's probably 2/3 of the types of requests that come in. But things like, I want to have a pet, I've been broken into, how much is my rent, am I in arrears, all these sorts of questions that come in on a day-to-day basis to property managers. Alex is going to take care of them and automate those responses as much as possible.
Hey Ben, we're out of time, but thank you so much for sharing this with us. I think it's a fabulous innovation. I just love AI and I love technology and where it's all headed. But the website is rentalheroes.com.au. Check it out. As I said, there's a nice explainer there that'll tell you all about it as well. Tremendous benefits for property managers, even greater benefits for property owners and tenants. Ben, thanks for your time.
Thank you so much, Kevin. Much appreciated.
There could be more money in your investment property than you realise. BMT tax depreciation finds, on average, between $5,000 and $10,000 in deductions in the first full financial year for residential property investors. They'll work with your accountant to make sure no depreciation deduction is missed. They even provide comprehensive ATO-compliant tax depreciation schedules that last the life of the property, up to 40 years. And their fee is 100% tax deductible. Call BMT Tax Depreciation on 1300 728 726 now for a free assessment of your likely deductions.
Welcome back. During the March quarter of this year, 87.7% of Australian properties resold for a profit. Only a minor portion of resales sold at a loss that can be attributed to COVID-19. That's according to CoreLogic. Eliza Owen is with me to detail more findings from CoreLogic's latest pain and gain report. Eliza, welcome to the show. Of the 87.7% that I mentioned, what's that measured from?
So we do an analysis of resale events, any sale result we've collected that has a historic or a past sale associated with it. And that way we can get a sense of the portion of properties that are have resold for a profit or have resold for a loss during the March quarter. So over that time, we've looked at roughly 73,000 resale events. And so that's where we get the sense that there's, 87.7 of those had sold for a profit. It's a little bit lower than what we saw in the December quarter, where there were 88.7% of sales making a profit, but still a fairly high level of profitability, given that we saw these kind of strict lockdown measures coming in towards the end of the March quarter, which definitely slowed down sales activity.
I can imagine too, if someone maybe purchased a property 18 months ago and then turned around and resold it, it probably would be sold at somewhat of a loss. So I guess you've got to measure it on how long the people have owned that property as well.
Yeah, absolutely. So in the pain and gain analysis, we do all sorts of views around how long people have held properties for and what kind of result that would return for a resale. A lot of it does come back to the housing market cycle. As you say, if you buy at a high point and then 12 months down the track, the property market has gone into this downswing, you're more likely to resell at a loss. Typically, we see that profitable sales are held for a median hold period of 10 years. We also find that owner-occupiers are more likely to be holding on to their property for a bit longer because they're using the property to live in, whereas investors are more likely to make a quicker sort of turnaround on their sales and might be more willing to cop a loss on their sales because of the potential ability to claim those losses on money gained from property down the line.
Of course, we're looking here at comparisons, so the March quarter, which is really when COVID started to roll out, and comparing that to the latter part of 2019, I would assume, therefore, that as we get into the next quarter, the results are probably going to be more reflective of the impact of COVID.
I absolutely think that is the case. We did look at how loss-making sales kind of changed in response to the impact of COVID-19, and particularly things that kind of slowed down economic activity and transaction activity in property. What we found was that from mid-March, where we got the stricter social distancing measures in place, was that the portion of loss-making sales didn't really change, but I think it was kind of too soon to measure. At that point in time, transaction activity had just dropped off more generally. But I think looking at the June quarter, we might see more loss-making sales as people realize they might not be able to hold on to their properties. But I think because of the institutional intervention and the policies that are in place, it's not going to be a drastic blowout in the portion of loss-making sales. I think it'd probably just be an increase of a few percentage points perhaps over the next quarter.
What about in the variation between houses and units? Did you notice much difference there in the number of properties that were sold at a loss?
Yeah, so that's a pretty consistent pattern that we see historically. A pretty high portion of houses usually sell at a profit relative to units, and that was no different in the March quarter. We saw about 90.3% of houses selling at a profit compared to 80.2% in units. So there's quite a divergence there, and that divergence is particularly exacerbated in areas that have a very high portion of investors. So say, inner city parts of Sydney and Melbourne, some of those mining regions where investors were more skewed towards unit stock. But generally the houses tend to have higher levels of profitability than units.
Were there any parts of Australia where, there wasn't a really dramatic increase in the number of loss-making property sales?
Yeah, so interestingly, there were two capital city regions that saw an increase in profitability, and that was Hobart and Sydney. So these two cities in the March quarter had seen a pretty steady level of profit-making sales. There are also parts of regional Australia that are kind of close to those city centres of Sydney and Melbourne as well. So Geelong is an example of where we typically see a very high portion of profitability, and parts of Tasmania as well that see that spillover of growth from Hobart. Having said that, I think that those regions are going to be subject to a bit of a shift in that dynamic because of COVID-19. So Hobart, for example, that has very high levels of profitability in its resales usually, might see a bit more structural damage from the fact that a lot of people working in hospitality, tourism and the arts have sort of lost their jobs and seen a big loss of income. And I think that's going to affect dynamics, particularly for that city that has a high level of exposure to that segment of the workforce.
Yeah, I know this report focuses on pain and gain, or loss and profit, but it's interesting, correct me if I'm wrong here, but it seems to me that COVID's had more of an impact on the number of sales as opposed to the number of loss-making sales. Is that fair to say?
That is fair to say. So what we saw when the lockdowns around border closures and economic activity came into place, the portion of loss-making sales over the quarter actually stayed quite steady, whereas I think the real impact we saw from COVID was just a fall off in transaction activity. And that's a sign that I guess if people are thinking they need to sell their property, they're not doing it right now because of that economic uncertainty. And again, that's really been helped by the banks offering this pause in mortgage repayments, as if to say, if you think you're going to have to sell at a loss right now, you don't need to right now, and they can sort of postpone that decision and see where the economy is at that stage.
I've been talking to Eliza Owen from CoreLogic, and the CoreLogic Pain and Gain report is a regular report that comes out, and we like to focus on it because it gives us a good indication about what's happening in the market. Eliza, thanks very much for your time.
Thanks for having me.
Reports recently have indicated Melbourne saw the largest decline in property values over June, with a 1.1% fall on the previous month. As Sydney continues to exit lockdown and market confidence grows, we realise that the market is so different state by state. Josh Masters joins me now and gives us an insight about the differences. Hey Josh, welcome to the show.
Thank you, Kev. Thank you for having me.
Pleasure, mate. Now, you mentioned that values fell slightly in June across the cap cities. Let's bring up the medians from your report. Firstly, we'll have a look at houses, Josh. We can see there Sydney, yearly growth 15.5%. Nothing shabby about that, is there?
No, look, that's a pretty solid growth rate. But we have to be mindful that is a 12-month growth rate, and obviously you'd have to be living in a hole to think that the last few months haven't taken a dramatic effect on the marketplace. So the first 6 months of last financial year, July to December was a stomping growth rate for both Sydney and Melbourne, and they really surged forward after a couple of years of decline. But now we're starting to see things really plateauing out, which I have to say is probably a positive thing given the circumstances. We haven't seen any dramatic declines, but I guess the news reports now have to talk about something around June and even from March, and they're talking about declines, but we're really only talking about probably 1 or 2%. Around, give or take 1 or 2% around the median price point, which is pretty solid given all things considered.
Okay, well, we'll come back to these figures in just a moment. We're going to walk through the cap cities with Josh as well and talk about some of the key findings in his report. But before we do that, let's bring up the unit report, similar to houses, following the same areas. What's your view on that, Josh?
Yeah, units are trailing houses slightly. Obviously, the investment focus has probably slipped from most people's minds. On the ground, as a buyer's agent, I'm finding that there's still quite strong demand in the housing market. People still have to live somewhere, but the urge to get back into investments probably hasn't come really back into favour just yet. Obviously, the yearly growth is measured from 12 months right through to today. But if we were to look at the most recent growth, the last month or the last quarter, we probably see a slight decline greater than houses over that same period. Yields will obviously be a little bit higher, but I think probably another conversation that we could have here, Kev, is really around the vacancy rates that we're starting to see in some of these unit markets, particularly in inner city, Sydney and Melbourne, where people just aren't going into the city anymore. We've got a lack of overseas people coming from either interstate or overseas to travel for work or students, and we're not seeing people using the city as a base to go to their office anymore. It's like a ghost town out there. So we're seeing vacancy rates above 5% in some of those areas, and I think we'll see some of the data here lining up that stock levels in the city are now hitting 40% plus coming onto the market for rentals, which is unheard of, really.
Well, we'll go back to that original house graphic. We'll keep that up as we walk through the cap cities and just get some of your key takeaways or what you're talking about in each of those areas. Sydney, you focus first up on the job market.
Yeah, look, I think underlying all property markets is the economy, and if you're interested in how the property market will perform over time, we have to look at the economy. We have to look at how jobs going. Obviously, we're going to be talking about Melbourne in a minute, and the sort of downturn into the second COVID sort of response. But right now, we are concerned about where jobs are going for the Sydney market and how that will perform over time and what will happen once stimulus ends. Right now, the market is remaining pretty resilient. Fall slightly by 0.8% over June, which is really negligible. Auction clearance rates are bouncing back. We're seeing some good stock levels coming back onto line. We were really struggling here with finding good stock, which I think has been holding prices up generally. But Confidence is definitely growing. We're seeing that. So that's been solid. But again, one of the key points that I make in this report is, REI in New South Wales puts the inner ring vacancy rate at 5%, which is the highest in 18 years. So we're really seeing changes in these particular markets, which we haven't seen before, and is not reflective of all of the capital city. We have to take each sort of little market as it comes.
Yeah, we're seeing the inner city, certainly in Sydney and also in Melbourne, being quite resilient. But you are reporting that inner city units and even some of the outer suburbs are not proving to be, they're proving to be much less resilient. So, but let's go to Melbourne, and there we look at, as you just mentioned, I guess all the focus has got to be on those new restrictions for COVID.
Yeah, look, my heart goes out to the people in Melbourne going through that second round, and look, fingers crossed we don't have to go through the same thing. But, Melbourne used to be the poster child of overseas migration and interstate migration, and it really drove population growth and hence transferred into rising property prices. Now that's all finished for the time being. So we're really suffering of people not coming into the marketplace. We're seeing the inner city market really being drawn away and having huge vacancy rates there. And obviously, this second wave of restrictions coming in, it's not going to be favourable. And obviously, a lot of real estate agents who thought they could get back into the swing of things and start opening up for auctions and getting people through public inspections now really have to go back to a trickle of people going through their open homes and trying to sell those in that environment. It's very tough.
You point out that Melbourne actually recorded the highest fall off in property values in June, and I guess prices are definitely the focus in Melbourne. I think you mentioned in your report Domain's Trent Wiltshire saying that he believes that Melbourne's going to be the hardest hit in terms of prices.
Look, at present, I think that's very correct. Given this second wave, I mean, no one wants to go through a second lockdown. The fact that Melbourne has had to do it and nobody else has at this point kind of points to the fact that they will find it difficult to see price increases. Yes, they have had the biggest decline in values, over June and the quarter. I think from memory, CoreLogic was recording, minus 2.4% for the quarter. But, is that a big thing? Minus 2.4%? Yes, if you extrapolate it out to the year, we might see a more significant fall. But if it rises another 1 or 2%, in the next quarter, then it could all be made back. So I'm not taking those monthly sort of changes, to heart right now. I think we take it with a grain of salt. But I have to admit the outlook doesn't look great. And obviously, the stimulus measures coming off in September and October will probably have a more of an impact in that respect as well.
Let's go to the Sunshine State, Brisbane. And Brisbane there, of course, the focus has got to be on border closures. And given that there's so much tourism reliance in Queensland, that's had a pretty big impact.
Yes, it has. And look, people moving interstate or coming from overseas, obviously the tourist dollar in Queensland is driven by that, which is great. Fortunately, I know you're a Queenslander heart, Kev, and you're probably enjoying the fact that you have very negligible numbers when it comes to COVID. So everybody within the state is doing fine on a health perspective. I don't think the investment market is doing great there right now. Obviously, apartment approvals are at an 11-year low right now, as we've said in the report, down 7.4% for May, which is translates through to construction and through to jobs effectively and how people spend money. But there is a resurgence in, tree change properties, and those who have seen this dilemma with COVID and thought, I think we need to get into a bigger property. We don't want to live in the city so much or around people. Let's go out and buy a little bit of acreage and have the space to ourselves. And if anything, that's a positive thing. And of course, regional hotspots like Sunshine Coast, Mackay and Gympie, Mackay, I should say, and Gympie, all performing well with an average increase of 4%, according to CanStar. So, I think we're going to see a change in the way people do a lot of things. Work environments are going to be one of those. And look, there's nobody that I've talked to that is keen to go back to their little office cubicle in the city. I think a lot of people are looking at the way we work now and things like Zoom and how we can work remotely and saying, you know what, why don't we focus a little bit more on family, go to these areas with a little bit more of a lifestyle focus where we can still work and be productive, but we can also enjoy family time and not be living on top of each other in the urban dwellings that we're so used to.
Indeed. Well, Darwin and Perth are two areas, as you might recall from our earlier graphic, showing negative results year on year for properties in both houses and units. Let's have a look at Perth firstly. Forecast is a bit of a bounce back. Maybe building numbers are looking more healthy.
Yeah, it looks like building numbers are a little bit more healthy, and it was interesting to read that HIA had recorded, 132% rise in consumer interest visiting display homes. I think the home market is definitely there. I don't think the investments are going to be bouncing back anytime soon. Obviously, Perth and Darwin coming off very low lows. Really, they've been languishing. Really, for the last 5 to 10 years, and really haven't seen that bounce back. Auction clearance rates in these states aren't anything really to speak of. It's not a strong method of sale. But all in all, we may be seeing some green shoots there. Hopefully, we'll have to see how that goes.
Yeah, we've heard of that happening in Perth before. We'll get to Darwin in a moment. Before we do, let's go to Canberra. And Canberra's an interesting market because probably over the last 6 weeks, they've recorded record high clearance rates, although this last week they fell behind Adelaide, but certainly a resilient market, Canberra.
Very resilient market, driven mostly by government bodies, of course, and, in a health crisis like this, very manageable to be able to lock down and keep people out where they need to, which is probably given some confidence to the people in the Canberra market, and auction clearance rates are certainly showing some positive signs there. And in the last week of June, they had 84.4% auction clearance, which is unheard of really in this time. And look, over the year, Canberra hasn't been doing too bad. This has definitely been one that we've had our eye on for the last 12 to 24 months in terms of property pricing. Obviously, the markets have been very solid, and one thing that isn't mentioned here is the rental market. As far as the country's performance goes, the rental vacancies in Canberra have been extremely low. They've been in 1 and less than that, 1% less than that. So very, very solid in terms of investment moving forward. But the focus just isn't there right now. Most people are focusing on either buying a new home or shoring up finances. So we're seeing only a trickle coming through to the investment space.
Adelaide is next on the agenda, and that's an amazing market, Adelaide. Certainly not one that gets a lot of headlines, but it is a pretty solid performer. There's some great suburbs in Adelaide that are doing quite well, Josh.
Yeah, they have been quite resilient. I mean, Adelaide's only, a population of probably half of Brisbane, odd million people or so. One thing I thought was interesting coming from the Real Estate Institute, just saying, the market's very steady, but if we had stock increases here, and that translates to people feeling more confident, listing their homes for sale, we would have potentially some issues with pricing here. Which just goes to show, I think, countrywide, the confidence has bounced back somewhat. And, Melbourne Institute is saying that, 16.4% in the last month as a bounce back for confidence. But most people generally aren't that confident that they'll get the same prices that they would be happy with maybe 12 months or 24 months ago, and simply aren't listing their property, which is keeping a real crimp on supply. And when that happens, you can have these buyers coming into the marketplace, but if there's no stock to buy, it really either it keeps prices plateaued or it drives prices up, and that's what we're probably seeing in Adelaide as well. I mean, some of these areas like Glenelg North and Henley Beach recording 1 year increases of 23% with these sea change areas. I think is fantastic for the people in that area, and hopefully we'll see more of that.
Let's round out this report by having a quick look at Darwin. Darwin seems to be, and you highlighted in your report as defying all the odds. REA reporting very good buyer activity in Darwin.
Yeah, look, it's defying the odds in that it's not falling anymore, which is a great sign. I think Darwin's really been whacked with a big stick for the last few years. They lost some LNG contracts. Obviously, the mining downturn really hit them, and they haven't really bounced back. But in this time, they've been quite resilient. And I think again, we're probably seeing buyer activity coming in. One thing that we haven't talked about to this point is, quite frankly, we've got the lowest of low interest rates that we've ever seen on record. It's actually more affordable probably for a lot of these people to actually go in and buy property rather than rent.
No, indeed. A great report, and you can get a link to it on the underneath this video, so check it out for yourself. My guest has been Josh Masters from Buyside. Josh, thanks for your time and thanks for your insight.
Thanks for having me, Kev.
With the evolution of social media, marketing of property is no longer linear. Consumers are influenced differently. The Property Show is unique in that it empowers agents to connect with buyers and sellers through personalised content, social media and artificial intelligence. The Property Show delivers personalised, laser-focused marketing by combining new media, social media and audience targeting, and gives the agent a digital voice. See how well the Property Show works, and then let's get started telling the world about your property. See it now exclusively at realty.com.au. What can you get for $700,000 if you're shopping for a property? Well, it will vary greatly depending on where you want to live or invest. Heron Todd White looked around the country so we can prove it is possible to buy a property for that amount in all the states. I'm joined by Drew Hendry to take a look through the possibilities. Drew, let's start in New South Wales. I guess there you'd be looking at a unit, wouldn't you, around the $700,000. What about regional New South Wales?
Yeah, look, Kevin, you would think so in the metropolitan locations around Sydney, although you'd be surprised at what you can achieve for $700,000 in Western Sydney and also around inner Sydney and eastern suburbs. There's still quite a bit of value to be seen in those areas around, around Western Sydney and inner Sydney. But as you said, in regional New South Wales, we've certainly highlighted Lismore as an area where there's quite a bit of value. Although not a lot has changed over the last year or so throughout those locations. But around Casino, Lismore, your 700,000 will pick you up a good sized rural residential property or a nicely sized family home.
Of course, Melbourne right now too, we've mentioned it already in this show, in the middle of a bit more of a lockdown, but I guess we're looking at the broad term here. Melbourne, you say in your report that 700,000 can go a long way. How far?
Yeah, well, I mean, we like to be optimistic, but Melbourne is obviously suffering the effects of this second wave at the moment, and that in itself is creating some value in some markets. Yes. But Melbourne is and has traditionally been, as we know, a more affordable city, especially in comparison to Sydney from a median house price perspective. And really there are still some great value suburbs around, certainly in the north, in the inner west, that you can find quite new stock on the market for less than 700,000. And that's one of the reasons why Melbourne has been so attractive to first home buyers for a long period of time.
Yeah, let's go to Queensland now, and I guess you'd be looking at the Gold Coast. There's a lot of good buying around the Gold Coast, but what about regional Queensland, around Hervey Bay? There's been a lot of stock there in recent times, but what's that market, how's that performing now, Drew?
Yeah, look, Harvey Bay, Mackay, they are going okay, considering, and really what we're looking at there is the effect that that this pandemic has had on the tourism market, and to that point, there has been quite a bit of stock on the market in certain key areas. But there's, your 700,000, particularly in Mackay, will pick you up a really well appointed or fully renovated home. Harvey Bay, you'd be looking at something similar with or within really close proximity to the beaches, and really high level of appointment.
South Australia seems to be doing quite well right now. They went through a bit of a rough patch when some industries pulled out, but that's travelling quite well. I imagine 700,000 would buy you a nice property there in Adelaide.
Yeah, certainly close to the city, within really close, proximity to the beaches, potentially. And given that they've locked out the Victorians, I think that the prices have still held up really well, and also the Adelaide Hills too, Kevin. We can't. If you want something a bit larger, going out a little bit in Adelaide gets you an awful lot of value, and there's some really beautiful homes throughout the hills that are attracting some quite good prices too.
In WA, what are we seeing there?
Well, WA, Perth's market has probably been one of the markets that has felt the effects over recent times, and of course it came back quite a bit before COVID, and then it had to sort of suffer through this period as well. So there is quite a bit of speculative buying occurring. We've got a median house price that's on that has fallen. I think it's at 475 at the moment for the Perth market, and of course we've got fairly steady transaction rates now occurring in Perth. So, look, Perth has traditionally been one of those boom bust markets, as we know, but there is still value to be seen, throughout the Perth region. You have to go fairly, in suburbs like Bull Creek, for instance, which is quite considerably south of the Perth CBD, where you can pick property up, and likewise in the southeast as well.
What about the ACT? Been very impressed with the ACT in recent times. Doesn't seem to have had much impact from COVID, but what are we seeing in there?
Yeah, look, it's been very consistent, hasn't it? And really, around the Lake Districts, Cook, all of these desirable sort of suburbs, there's been really strong capital growth, and as a result of that, 700 is it's still there's still property priced at that level, but it is becoming more challenging to find property lower than that. That's for sure.
We can't forget Tasmania. That's had a great run, particularly in recent years around Hobart and Launceston. What do you think's worth looking at in Tasmania?
Yeah, look, I mean, Hobart for a long period of time, as you say, has really been performing very strongly, and look, 700 wasn't going to pick you up a lot in a lot of the inner ring around Hobart, and indeed, over $1 million. It wasn't unusual to find sale prices over $1 million. That's probably eased back a little bit just with the restrictions on interstate travel. The speculation's probably come out of the market a little bit, but certainly, I'd expect to see, and we still have seen quite strong prices throughout Hobart. The northern cities of Devonport and Launceston, less so. There's still quite a bit of value in those cities, and obviously 700 will take you'll get a bit further more for your money.
Drew, great talking to you, my friend. Thank you very much. Drew is from Hare and Todd White and had a look around Australia. Thanks for your time, Drew.
It's a pleasure, Kevin. Good to talk to you. Bye.
Well, that's it again for this week. Thanks to our guests, Eliza Owen, Ben Burton, Josh Masters and Drew Hendry. We'll be back again next week with more great advice from our list of experts. And don't forget, you can catch up anytime at realestatetalk.com.au or see all of our shows at realty.com.au, the home of property. I'll see you next week. Real Estate Talk, part of the Realty Media Group. We also produce The Property Show, Real Estate Uncut and CoreLogic's auction update shows. All available for catch-up anytime at realty.com.au. Thanks to BMT Tax Depreciation, Printforce and Propertyology for their support. Watch out for us in your inbox next weekend or catch us anytime at realty.com.au.